Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy, joined by the one, the only
Andrew.
Andrew, welcome back.
Hey, Bills, how you going?
Back in the recording studio.
Yes, back in the recording studio, the good old trusty boardroom here at the 360 Financial Office.
That's right. And it's absolutely freezing because the heater is broken in the office.
That's exactly what you want in winter.
So our teeth may be chattering during this podcast, but I think we'll be right. But we've got
braving it for our viewers. This is the lengths that we're willing to go to for our listeners.
whatever it takes, right, to create some value and spread some love and spread some knowledge. And hopefully this one hits the nail on the head, because I reckon this one's always been pretty relevant and pretty big consideration for, I guess, a vast majority of the population. And let the cat out of the bag, we're talking about property. And one of the things about how do we get into the property market faster, and one of the considerations that we take when we're doing that. But Andrew, specifically, what are we talking about?
Yeah, so today we're talking all about lender's mortgage insurance, so LMI, what it is, how it happens, or what impacts it, and really trying to answer the age-old question, which is, do I pay LMI and purchase a property now, or do I hold off and not pay LMI so that I can save a larger deposit and not need to pay the lender's mortgage insurance? So LMI.
So one would say to pay or not to pay. That is the question.
Billy was smiling and I knew a comment was just ripe and waiting to happen. He was ready for that one.
I was waiting for the opportune time. So I think we should probably start with what LMI is. So lender's mortgage insurance, just because that's a mouthful, we'll refer to it as LMI just because that's a bit easier. So lender's mortgage insurance. So as it turns out, it's an insurance product. And essentially, you as the borrower pay the insurance premium if you borrow more than 80% of the value of the property that you're purchasing. And the insurance premium that you pay is designed to cover the lender, so not yourself, in the event that down the track you can't afford your repayments. Then the lender needs to sell your house. And if there's a shortfall between what they sell the house at versus what they get on the day of sale, if there's a shortfall, the lender will make a claim against the insurance policy that you've paid for and recoup the difference.
Yeah. So basically, you're paying a premium so that the bank can protect itself from you, in essence.
Yeah, so you're paying for an insurance premium that you never get the benefit of.
Yeah. So why would you pay it?
Well, look, hopefully we're going to answer that in a really long-winded way. And we're going to have an example as well too, because it's not as simple, but all of it comes down to opportunity cost, I think, to give a short answer without giving it away.
Yeah.
And it's a worthwhile strategy. I mean, look, thinking back all of those years when Samantha and I bought our first place, we ended up paying lender's mortgage insurance because the truth was, if we waited to continue to save, we'd probably still be saving now, realistically. But we'll get into that with the worked example and stuff. But yeah, just getting it clear in our minds, it's an insurance premium that you incur for someone else's benefit.
Yeah. Yeah. And it's, in essence, you have to pay it. So if you've only got a 10% deposit, the bank will not let you purchase or will not lend you the money without you paying mortgage insurance. And so if we've got a lower than 20% deposit, it's something that you're forced into doing if you are going to embark on taking out a mortgage and purchasing property.
Spot on. I reckon the best way to illustrate this, Andrew, is probably using an example. So this may get a little bit difficult because we are doing it via audio. So we're going to use some round and some generic numbers that are easy enough to use and interpret. But we're going to use an example about, say, a property purchase of $1 million. And we're going to run two scenarios, one at an 80% loan to value ratio, so where you don't incur LMI, and then another one at 90% where you will incur LMI, and put some numbers around what that looks like in terms of costs, deposit, lender's mortgage insurance, LMI premium, what impact the insurance premium will have on your cash flow as well. Because the other thing with this premium, you can actually roll it into the loan. So it's not like you need to find that additional money like you do with a deposit or stamp duty. It can get added to the top of your loan. So that's a really critical part, because when we break the numbers down and look at the strategy overarching, in the right circumstances, I actually think that going down this path could be a viable strategy and a viable option for a lot of people.
Yeah, absolutely. And I think the big thing to point out here when you're talking about 80%, 10% in terms of a deposit, a lot of people get caught up in the fact of purchasing a property for $1 million and I've got a 20% deposit. So I've got $200,000. That's it. I've got a 20% deposit. But the thing that is always forgotten about is stamp duty. So when we're talking about purchase price of $1 million, we're talking in this scenario, a purchase price of $1 million inclusive of stamp duty, not exclusive of stamp duty. So really important to note that if you're purchasing a property for $1 million and you want to have that 20% deposit, you also need to have the additional circa $60,000 for stamp duty as well on top of your original deposit in order for it to actually be a 20% deposit. So stamp duty needs to also be factored into this also.
So in this example, $1 million purchase, 80% loan to value ratio, you're going to need approximately $260,000 in order to complete the transaction. That's it. Yep, that's the number. So 260 is what you'll need to save just to get your name on that title.
Yep. And this doesn't also include, the costs of a conveyancer, the costs of building inspections, the cost of potentially property advisor, so someone like a buyer's advocate or something like that. This is purely just looking at the cost of the property and the stamp duty cost.
Yeah, just some high level numbers.
Well. There are obviously going to be some additional costs that you're going to need to factor into this overall scenario as well, but approximately $260,000 is what's required on $1 million property in order to avoid any lender's mortgage insurance, so any LMI.
We won't dwell on it too much because that'll take away from the example, but you wouldn't want to shoot all of your bullets, as in you wouldn't want to use everything that you've got in savings to put down as your deposit. You're going to want to have some money left over as well too. So if you think about that on top of the 260, it gets even bigger.
Yeah, I mean, you talk about savings buffers, you talk about if you're wanting to do any renovations, if you're wanting to pay for furniture, if you're wanting to do anything else. I mean, there's some other very significant things that you're going to need to consider when you're talking about purchasing a property as well. So yeah, having $260,000 in savings is probably not enough, or definitely not enough in our opinion anyway.
So we'll stick with 260. We'll ignore those other costs because I think that's the way to go. If we then pivot from, say, 260 is the amount of money that we need for $1 million purchase, and then we focus on, say, a 90% loan to value ratio, we're looking at a different amount of money because we are paying lender's mortgage insurance. We obviously move from a 20% deposit required plus stamps down to a 10% required plus stamps. Just before I give the number, you can trigger lender's mortgage insurance above 80% up until around about 90% loan to value ratio. And the closer you are to the 80% loan to value ratio, the cheaper your lender's mortgage insurance premium will be. So obviously the greater the risk that the lender is assuming, the larger the insurance premium, which works no differently to other insurances anyway. But in this instance, just because it's nice and round numbers, we're assuming a 90% loan to value ratio. If we bought a $1 million property with a 90% LVR, 10% deposit, roughly speaking, your lender's mortgage insurance premium will be $28,000. So $28,000 plus the 10% deposit plus the stamp duty, we're looking at about $190,000 total amount of money required in order to complete that transaction. However, if we wanted to, because this is an option, that $28,000 additional cost, we can actually put that onto the loan. So rather than borrowing $900,000, we can actually borrow $900 plus the $28,000 lender's mortgage insurance. So in this instance, it'll go down from $190 to about $160.
So really what you're talking about in that scenario, if we're talking about 90% plus LMI, as opposed to 90% inclusive of LMI, what we're talking about is not having to save $260,000 for a deposit, not having to save $190,000 as a deposit if we're paying the LMI up front, but actually $160,000 as a deposit if we then put the LMI on top of the loan.
Yeah.
So what we're talking about is really $100,000 in savings that someone doesn't need to come up with where they can enter the property market. However, what that means is they're also incurring a cost of $28,000. It's not a small amount of money to be sneezed at.
No, and on balance, when you look at it like that, so $100,000 less required, but I'm going to pay the privilege of a $30,000, let's call it a fee. I'm going to pay $30,000 to save $100,000. It doesn't sit well. It's a big ask, 100%. So when you look at it on balance like that, you turn around and you go, nah, not going to do it. I'm going to save the extra $100,000. No issues, not a problem at all. What we're going to do now is talk through some of the numbers behind that and actually make some assumptions around this, because going back to my previous comments at the start, there's actually a business case for this to say, you know what, actually, there's more to it. Let's dig a little bit deeper. This may be the right way to go for your circumstances.
Yeah, which I think in many instances, especially when I've been, discussing this with clients, most of the time people come in and their natural assumption is $28,000. If I'm saving $260,000 for a deposit, we're talking about in order to have a 20% deposit without having to pay LMI. As a cost, it's 10% of my overall savings. That's massive. It's taken me so long to save this amount of money, and I'm going to end up paying $28,000 more in order to be able to have the privilege of purchasing a property along with all of the other costs associated with it. Most people fall at that hurdle and just hear that number and say, nah, I'm saving for a 20% deposit because I'm not going to incur that amount of money just to purchase or just to have the privilege of purchasing a property. But as Billy said, what we're doing is really digging a little bit deeper and looking at maybe this, for some people, isn't the worst of things to do. And maybe we're actually better off incurring the mortgage insurance, incurring LMI, and getting into the market faster. And really just comparing and contrasting those two scenarios so that you can make an informed decision around, hey, is this something that I actually do go down, or do I fall over at that first hurdle and say, I'm not paying the additional funds?
Yeah. And you know what? I think the best way to sort of work through that is let's put an example behind it. So if you make the decision to get your 20% deposit and you need to save an extra $100,000, the question that I'd be asking myself is, how long will it take me to save $100,000? It's not a small amount of money. It's going to take some time, right? That's a fair generalized statement right across the board. So the way that I'd be looking at it is to say, okay, for me to save that extra $100,000 to avoid paying the $28,000 LMI premium, how much longer is it going to take me to save that $100,000? That's the first thing. The second thing is depending on what the property market is doing, and this is one of the fundamental challenges that we face with property in a rising property market, is your deposit, the rate that you can save at, can't keep up. The environment that we're in now is different, but traditionally, the rate of saving for your deposit can't keep up with the property growth. And what I mean by that is really simplistic example here. If you wanted to save, say, $28,000 a year for your LMI premium, that's $600 a week. That'll take you a year to get $30,000. If the property that you're purchasing increases in value by 5%, on $1 million, that's $50,000. So you're better off by $20,000 in this example, buying the property 12 months earlier than 12 months later. If it takes you 3 years to save your $100,000 and that property goes up 5% each year, you're talking about that trade-off being even greater. So that's the real consideration here, I think, is your opportunity cost around time and how much longer will it take for you to get into that property just to avoid lender's mortgage insurance.
Yeah, exactly right. If we put some context around it and say, $100,000, especially if you're talking about a single income, I mean, it becomes a little bit easier when you're talking about two people saving towards a property. But if you're saving $100,000, once you take tax into account, once you take or tax on your income into account, and you take all of your living expenses into account, maybe you're saving $30,000 a year. If you're saving $30,000 a year, what we're talking about is 3 years in order to be able to save up that extra $100,000 for a deposit. If in Billy's scenario, we're talking about a 5% growth a year, and we're not even going to take into effect the compounding effect, and all that we're going to do is just look at an additional $50,000 a year. Property's gone up by $150,000, and all that you've done is avoided a cost of $28,000. So you were far better off purchasing that property sooner, paying the mortgage insurance, and essentially having or riding that wave in terms of capital growth on that property. And in that scenario, you've netted out $150,000 minus $28,000, $122,000 worth of net asset increase in wealth, despite the fact that you have paid $28,000 initially. So in an environment where properties are increasing in value and we're taking into consideration a 5% increase in property prices, in that scenario, you're actually far better off paying the mortgage insurance, despite it kind of maybe hurting a little bit mentally, because at the end of the day, you would have made significantly more money by getting into the property market sooner rather than later.
Yeah, and they're all big numbers, and what I want to do now is probably look at it in a way that I think is a lot more digestible rather than throwing around these really big numbers because, yeah, they are big. And what you did made sense. And it even makes me think, Andrew, we've got to get this podcast somehow on video because we definitely need a whiteboard to be able to illustrate this. But to put it into some context that I think really helps drive this point home is, well, let's use as an example. After this podcast, Andrew and I are going to go down the street and get a coffee. So half full latte for me, please. And Andrew will pay for it today. We'll do it tomorrow. I'll buy him a coffee. It's kind of like the currency. It's no big deal. It's $4 or $5, right? Just keep that in mind because that sounded irrelevant, but I'm going to come back to that in a sec. Here's some numbers I prepared earlier. On a $900,000 loan, now we've gone and assumed an interest rate on principal and interest of 4% over a 30-year term, but your repayments per month are about $4,300. That's what it is in the event that you're borrowing $900,000. In the event where you're capitalizing the mortgage insurance premium into that loan, so you're adding $28,000 on top, your repayments increase from $4,300 per month to $4,430. So essentially what we're looking at is an additional $130 a month.
Yeah, that's the cost of mortgage insurance.
That's the cost of mortgage insurance, and that's over the life of the loan. Just to add some financial wizardry to it, if we look at the cost of $130 per month and break that down to a daily cost, and I've done this intentionally, but it's about $4.40 a day.
A cup of coffee a day.
That's exactly the reason why, because when you think about it in that context, like we'd go down the shop and we'd buy a cup of coffee and you'd shout me coffee. You wouldn't even think about it. And, realistically, I love coffee. I'm probably drinking somewhere between 2 and 3 paid cups of coffee a day from the local coffee shop, trying to do my bit for the economy. If you think about that flippancy around that, you could do that. And that could mean the difference between getting into your house today or potentially getting into your house in 2 or 3 or 4 years' time down the track, but needing to concede if we're in a rising market where what I could buy today is going to be different to what I can buy in 3 years' time. So when you look at it like that and you break those numbers down, in my opinion, it actually doesn't seem that bad.
Yeah, absolutely. And what we're looking at in this scenario is quite simply the scenario of you purchase a property sooner. And so the fact that you're purchasing a property sooner means you've got the ability to have capital growth sooner rather than later and be able to ride that wave in terms of appreciation in property prices. But the thing that this also really doesn't take into account, and it's almost impossible unless you're looking at it from an individual level, is if you purchase a property today and you're purchasing a property at 90% LVR, in 3 years' time, which is the time to be able to purchase a property, having saved the additional 10% deposit, let's say Billy's purchased that property today and I'm deciding to wait for that 3 years in order to be able to purchase that property. What I would, and putting my financial planning brain on is if Billy's purchased the property today, in 3 years' time, he's made repayments on that property. In addition to that, Billy's also gotten into the property market sooner, so his LVR is decreasing over time because the value of his property is also increasing, so he's creating equity within his property. So in 3 years' time, when I'm ready to make that first purchase of a property, very likely what Billy's ready to do is actually draw some equity out of the property that he's already purchased. And he's looking at purchasing another property. He's looking at an investment property, or he's looking at increasing the portfolio in terms of his total assets by drawing equity out of his property. So not only are you getting into the property market sooner and riding that wave in terms of capital growth on the existing property, but what you're also doing is bringing the time frame forward to be able to create equity, grow your wealth, and acquire more assets in a shorter period of time, as opposed to continually waiting for 20% deposit, 20% deposit, 20% deposit in order to be able to continue to leverage your wealth. You're doing everything at a far more rapid rate and you're acquiring assets at a far more rapid rate. You compound that over the course of 30 years. The difference is night and day. We're not talking about, $120,000 over 3 years in terms of what you've missed out on. But we're now starting to talk about millions of dollars worth of overall assets once we start to compound this over the course of a lifetime of investing.
Absolutely, Andrew. You hit the nail on the head. And I think probably the thing with all of this is And I want to try and give some comfort around this, but you need to feel comfortable regardless of what you're doing. So if you are borrowing at 80% or if you are borrowing at 90%, you're going to need to feel comfortable doing that. And some people may not feel comfortable going that hard. I've got a different way of looking at it just in terms of my own sort of thoughts. And it's not necessarily, yes, your LVR position matters. And don't get me wrong, I don't want to downplay that. But it's your ability to continue to service that makes the difference. So you could have an LVR of 20%. And if you lose your job, okay, you've got more choices because you've got more equity in the property. But if you can't service the loan, you're still in trouble. And that doesn't change if it's an 80% LVR loan or a 20% LVR loan. You might be able to refinance, reset the loan term over 30 years, and you've got more flexibility, don't get me wrong. But what I wanted to point out is fundamentally, the repayment rate will be the same. So it doesn't make a difference whether or not you're borrowing at 90% or 80% or 60%.
Yeah, it's making sure that the repayments are going to be affordable and that you're going to be able to continue to do that over a period of time.
So once again, it comes back to the comfort level overall and taking all of this into consideration when you are making that decision, and then looking at the trade-offs and working out the opportunity cost of either going one way or the other. And there's no right or wrong. It's different for everybody. As advisors, as financial planners, as professionals, we need to put those options in front of people, make sure they understand it, explain it to them. And when you do look at this, at the core of what we do as planners, we're talking about wealth creation. So going back to your example about being able to do this faster and faster, this is one of the ways that, especially from an investment perspective, you withdraw the equity out of a property, you use that as a deposit to get into the next one and sort of rinse and repeat. So that's a well-worn strategy that we've seen time and time again. But yeah, look, hopefully we did it some justice today. And I think it makes for a pretty compelling argument that it should be something that you should at least consider and not discount straight away.
Yeah, absolutely. And look, the really big things to consider are, what's the time frame and what are we talking about? Because if you are saving $100,000 a year and the property market is moving sideways or declining, or your expectation is that there's going to be some softening in prices, then maybe you do want to hold off, maybe you do want to wait. I mean, history has painted a very different picture to that. However, taking into account that, by increasing the loan, you're also increasing your risk, you're also increasing your exposure to future interest rate rises, all of that stuff withstanding. But if you do have the ability and if you do meet the criteria and everything else, I definitely wouldn't be completely discounting paying mortgage insurance. And to be honest, in many instances, we've recommended to clients that, hey, you're actually better off paying the mortgage insurance, whether that be capitalizing that on the loan or paying it off right at the very beginning of the loan term. You're actually far better off doing that, getting into the property market sooner rather than holding off at a later point in time. You also consider that maybe different when we're talking about $1 million purchase, but if we're talking about an investment property that's less at 600,000 or whatnot, sometimes the conversation isn't, hey, let's look at $1 million purchase for an investment property versus having less of a deposit and still purchasing for $1 million. But sometimes it's, what if we split this up? What if we say, let's look at purchasing 2 investment properties rather than having a 20% deposit on a $1 million purchase? You have a 10% deposit across multiple properties. So there are many different ways that you can utilize this for your benefit. And even though it does mean that you're paying mortgage insurance twice potentially, it can be a very worthwhile strategy to just step on the accelerator from a wealth creation perspective. But very important to consider your own personal circumstances and consider how this is going to impact you both in the short and long term and whether it's affordable and a viable strategy for you.
Andrew, well said and well summarized. I reckon we did that one a world of justice.
Yeah, made a bit of a case for mortgage insurance. Mortgage insurers are going to be loving this podcast.
Look, just something to consider when, because it's such a large asset purchase and it's such a large hurdle to get over that it has to be a consideration. And for us, it's all about looking at things from a different option perspective and presenting those to clients. Yes, we take an impartial approach. Client needs to be comfortable with it, but working through the numbers, it can be a viable strategy if that meets a whole range of circumstances and the client feels comfortable with it. So, Andrew, thanks for today.
Thanks, Bill. It's always good to jump on another podcast with you. And thanks very much to the listeners for tuning in. Details are in the show notes if you do have any other further questions or you do want to reach out to Billy and myself. And we look forward to catching you on the next one.
Cheers.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amiridis and Andrew Nicolaou of 360 Financial Strategists Pty Ltd, authorized representatives and credit representatives of AMP Financial Planning.